Financial Accounting Chapter 14. Introduction. Group accounting is implemented in the following way. In addition to each separate environment for different group companies, an additional environment is created for the group. Consolidation. This means that there is always one more group-related environment per counter than actual group companies in reality. Investments related to the group. How to account for your investment. As we already mentioned above, you should first determine what type of investment you deal with and apply specified accounting treatment based on the type. There are 4 basic types of investments: subsidiaries, associates, joint arrangements, other investments. Accounting for the group. Group accounts are primarily examined in number-crunching questions. Help is at hand, though, as there are pro forma for every calculation available in the book. For example, goodwill, post-acquisition profits, NCI, retained earnings, disposals, associates, and group exchange difference can all be calculated using pro formas. These pro formas are invaluable aids in helping you approach even the trickiest questions. A little bit of rote learning here is a good thing. Uniting of interests. Pooling of interests was a method of accounting that governed how the balance sheets of 2 companies were added together during an acquisition or merger. The Financial Accounting Standards Board, FASB, issued Statement No. 141 in 2001, ending the pooling of interests method. The FASB then designated only one method, purchase accounting, to account for business combinations. In 2007, FASB further evolved its stance, issuing a revision to Statement No. 141 that the purchase method was superseded by yet another improved methodology, the purchase acquisition method. Proportional consolidation. Proportional consolidation was a former method of accounting for joint ventures under the International Financial Reporting Standards, IFRS, that was abolished by the International Accounting Standards Board, IASB, on January 1, 2013. It was a method of including income, expenses, assets, and liabilities in proportion to a firm percentage of participation in a joint venture. Though the IFRS previously accepted the proportional consolidation method, it also allowed the equity method. Under the U.S. Generally Accepted Accounting Principles, GAAP, a firm interest in a joint venture is accounted for using the equity method. The equity method. Equity accounting is an accounting process for recording investments in associated companies or entities. Companies sometimes have ownership interests in other companies. Typically, equity accounting, also called the equity method, is applied when an investor or holding entity owns 20 to 50% of the voting stock of the associate company. The equity method of accounting is used only when an investor or investing company can exert a significant influence over the investee or owned company. Conclusion on group relationship. Before consolidation, relationships are determined in the group consolidation view. A dimension with necessary items used with the consolidation must be created in the consolidation environment. Hope for international harmonization. Harmonization is the process of increasing the compatibility of accounting practices by setting bounds to their degree of variation on an international scale. Harmonization aims to update, align, or even replace domestic standards with a high-quality set of international accounting standards issued by the IASB. Reducing differences in financial reporting between various countries would benefit a wide variety of users in understanding and comparing accounts on a much larger geographical scale.